This is Wills and Trusts, Chapter 8, where we're going to be talking about limits on freedom of disposition. Specifically, we're going to be discussing two types of limits, those that exist for protection of the spouse and those that exist for protection of the children. This chapter focuses on rules that may override dispositions that are made in either a will or a trust. These are rules that protect against both accidental and intentional omissions. Again, it's important to remember that these rules apply to both wills and trusts. This chapter is broken into 3 sections. Section A discusses the 2 marital property systems. These 2 systems are the separate property system and the community property system. We will discuss the built-in spousal protections in community property estates, and then we'll discuss elective or forced shares that you find in separate property estates. We'll also look at how some of these rules can be waived through premarital or marital agreements. In Section B, we will look at intentional omission of a child. Now, Section A and Section B discuss or address what happens when there is intentional omission. These are rules that are put in place in order to establish a minimum acceptable amount that spouses and children should receive. The rules in Section A in particular ignore the actual intent of the decedent. In Section C, on the other hand, we discuss protections against unintentional omission of both the spouse and the child. So these are unintentional omissions. Section C deals with changed circumstances that could result in accidental omission and what are called pretermission statutes. Pretermission statutes differ from these forced share statutes here in that they're meant to estimate the decedent's probable intent in light of changed circumstances. So again, the primary difference between sections A and B is that in sections A and B, we're looking at intentional omission. In section C, we're looking at unintentional omission of both the spouse and the child. Let's begin with section A, protection of the surviving spouse. The rules that apply to protect the surviving spouse depend on whether the married couple is domiciled in a community property state or in a separate property state. But before we delve into the differences between the two, I'd like to define some terms. Whenever we refer to the term separate to define property, whether we are in a community property state or a separate property state, separate means that the property is titled or owned by a person in their individual capacity. Okay. So you can think of it as being separately owned. So for example, if Jamie and Sammy are married and we say something is Jamie's separate property, then what we are saying is that Jamie is the individual owner of that property. Another term that we will use in both systems is marital property. In both systems, marital property is anything that is earned during the marriage. Now that we've defined these two important terms, let's discuss community property. Now, your book focuses on separate property more than community property, and that's because most of the states use a separate property system. But despite the fact that the greatest number of states use a separate property system, a third of the U.S. population lives in a community property state, because the states that do have a community property system are the most populous states in the country. In some ways, it's easier to determine property division in a community property state. Let's do a quick property law review of how property ownership is determined in a community property state. In a community property state, all property that's acquired before marriage is considered separate property. Also, any gifts that are made, including inheritance, are separate property, even if these gifts are made during the marriage. During the marriage, almost all property or debts acquired during the marriage is community property. Each spouse owns 50% of community property. Let's use an example to illustrate this. Let's go back to our married couple, Jamie and Sammy. Let's say that before the marriage, Jamie had $100,000 in cash, and he had paid $200,000 of a $400,000 note for his house, which we'll call Greenacre. Sammy owned a Toyota and had $10,000 in cash. Now let's fast forward 10 years after they got married. So Jamie had an illustrious career as an attorney. He made $300,000 each year of the marriage. Sammy became famous for their brilliant representation of indigent populations, but they only made $65,000 each year. Both Jamie and Sammy kept their money in separate bank accounts. Jamie kept making the mortgage payments and had paid off the remaining $200,000 on the note. So the house was owned free and clear and worth $450,000. Sammy paid $50,000 worth of renovations for the home and also paid for utilities. During the marriage, Sammy had also inherited a house, we'll call it Blue Acre, which was worth $1 million. So what are Sammy and Jamie's shares in the property at this point? Well, all property that was acquired before the marriage is separate property. So Jamie owned separately the $100,000 in cash and $200,000 of equity in the home. So Jamie owns about half of the house separately. Sammy owns the Toyota and the $10,000 in cash. Sammy also got an inheritance in his individual capacity. And so Sammy also gets the house, the Blue Acre house, for $1 million. What about the marital property? The property in green that was acquired during the marriage. Well, whatever property was acquired during the marriage is community property. So we have $250K towards the house and whatever is in the bank accounts that's left from the money that they earned yearly. So we'll call that the pot. So Sammy and Jamie each get half of the community property. So that means Sammy has 125 of the home and half of the pot, whatever that is. And Jamie has a similar share. Now let's say Jamie and Sammy have or adopt a child whom they name Sally. Jamie executes a will, and the will says that he leaves all of their property to Sally. Jamie then dies. Assuming that both Jamie and Sammy lived in a community property state for their whole marriage, who would get what property at Jamie's death? At Jamie's death, Sammy keeps their separate property and half of the community property. because that is what Sammy owned when Jamie was alive. At death, Jamie is free to dispose of his separate property and his half of the community property in any way that he sees fit. And so his will had said that he disposes of all of his property gives it to Sally. So then Sally would get all of Jamie's separate property and Jamie's half of the community property. The important thing to remember is that in a community property state, there are no forced shares at death. The community property system itself has already allocated during life that half of the community property goes to the surviving spouse. And because there is this allocation during life, it protects the surviving spouse. So there's no need for additional rules to override the decedent's bequest. And that is why Jamie is able to use the will to bequeath all his property to Sally. Now we're going to compare this to rules in a separate property state. In a separate property state, each spouse owns separately all the property that they earned before the marriage and all of the property they earn and acquire during the marriage. So each spouse owns separately all property earned before the marriage and during. Because of this, it is possible for one spouse to end up with the bulk of the assets. And so in separate property states, there exists laws that protect a spouse from being disinherited. In all separate property states except for Georgia, the law's answer to the problem is to use what is called an elective or forced share. You can think of these shares as the bare minimum that is acceptable to leave a surviving spouse upon death. Now, if the surviving spouse consents or consented during marriage, they can forego the elective share that the decedent is required to give. Consent can be acquired through a marital agreement or a premarital agreement. Now, it's important to understand the difference between the intestacy shares and the elective or forced shares. Intestacy laws guess at what the spouse would have wanted if they had left instructions for how the property should be divided. Remember, intestacy rules apply when there is no will or testamentary instrument. A forced share is based on public policy limits on testamentary freedom. And so forced shares apply when there is a will. A forced share is the mandatory minimum. Another difference between the two is that intestacy shares apply to probate assets, whereas forced shares also apply to some non-probate assets. What that means is, if property passes during life in a trust, for example, it would be a non-probate asset, and it would still be subject to a forced share. Finally, forced shares are often smaller than intestacy shares. A forced share is typically around a third, um, whereas intestacy shares can be 50% or more. What if there is no will, but the surviving spouse, would like to take a forced share? States will typically allow a spouse to choose a forced share, even if there is no will, and apply the forced share rule instead of the intestacy rule. Now, why might a surviving spouse want to do that? The forced share, we said, is typically smaller than the intestacy share. Well, if the decedent spouse has transferred most of their assets before they died, then using the forced share rules may give the surviving spouse more property than just taking what is left of the probate assets. When a surviving spouse decides to take a forced share, whether it be over intestacy rules or a will, we call it electing against the will. I would like to briefly discuss how to calculate the elective share. For the purposes of our exam, I will let you know which law the jurisdiction applies in regards to the elective share. There are 4 different options. The UBE question that I have seen that discusses elective shares applies the traditional rule. And the traditional rule is just that the elective share is 1/3 of the spouse's assets at death. Another option that a state could follow is by following the 1969 UPC and to calculate the elective share based on what's called the augmented estate. The augmented estate was developed to solve the problem of the fraud on the widow, which entailed transfers that were made by the decedent during life in order to cheat the widow out of money. So to address this, the augmented share was created, and the augmented share adds back in some of the property that was transferred during life if it meets certain criteria. The elective share is then calculated by taking a percent of the augmented estate, as opposed to only taking a percentage of the assets that were left at the decedent spouse's death. The third approach is to take the approach of the 1990 UPC, which is based on this partnership theory. To calculate the elective share under the 1990 UPC, you add up all of the property of both spouses, and then you allocate the property using a percentage that differs based on the length of the marriage. So if the surviving spouse and the deceased were married for a longer period of time, the surviving spouse takes a larger percentage. The 1990 UPC does also include some transfers that were made before marriage. Finally, the 2008 UPC modifies the 1990 UPC in that it puts a minimum amount that the elective share can be. and it adjusts the percentage that is taken in order to meet a minimum of 75,000 for the elective share. And with that, we conclude Section A of Chapter 8 on protection of the spouse.